This at all. We have Sarah Hewin of Stanchart standing by, waiting to answer all those questions. Sarah, thanks very much for joining me. We were having some trouble establishing that link with you, but now that we finally do have you, how voluntary can a voluntary private lender participation really be? And what is the exposure of the private sector to Greek debt? We've got all kinds of numbers floating around.
Well, the question as to how voluntary a voluntary rollover can be is an interesting one. I think that there's a certain amount of behind-the-scenes coercion which is going on for large banks, particularly state-owned banks in Europe, to roll over debt as it falls due. Now, the main thing is that there should not be seen to be any coercion, because if that's the case, then the ratings agencies have said that they will class Greek debt as in default, and if that's the case, then the European Central Bank has said that they will no longer accept Greek debt as collateral. So the definitions are quite important. The main difference really is that if in a truly voluntary situation, you frankly don't know how much debt is going to be rolled over. So it's a bit of a sort of shot in the dark as to how much you can rely upon the private sector to refinance that debt as it falls due. The overall exposure to Greece, I mean, again, an interesting question. We've got various parts of the sort of global economy which has exposure to Greece, but of course the main holders of Greek debt are the Greek banks themselves. The European banks hold probably 80% of foreign banking exposure to Greece, and amongst those European banks, it's France and Germany that have the major holdings. That's the major holdings in euro size, but if you look at what their holdings are as a share, as a percent of their assets, of banking sector assets, actually it's a relatively small amount. The Greek banks are much more exposed on that measure.
Do we have a count of what the Greek bank exposure will be, Sarah? And also tell me if you think this is likely going to be a haircut, whether it's voluntary or coerced voluntary, or however you want to put it. Is it going to be a haircut, which means a cutback in the principal amount itself, or is it going to be some form of a rollover? And again, are those nuances going to be taken into account when rating agencies decide if this is in fact a rating event or not?
Yes, those differences will be taken into account, and really what we're looking at the moment is the difference between a default, which would involve haircut on debt, or a voluntary debt rollover. So there's really nothing in between in terms of what the options are for Greece. The EU, the euro area at the moment is pressing for a voluntary rollover of debt, so that would avoid the Greek debt as being classed as in default by the ratings agencies. However, you talked earlier about the confidence motion that Greece faces, the Greek government faces tomorrow. If it fails to survive that confidence motion, or if it fails to push through the austerity plans next week, then there is a risk that Greece could end up in default. It won't receive support, financial support from the EU and IMF, and without that financial support, it can't repay debt falling due in July and August. So there are really two options. One is a very tough option, the default. The other is a softer option, which is the voluntary rollover of debt on the part of private sector bondholders, predominantly the European banks, predominantly the banks that are state-owned.
All right, so you pointed out that if there is a voluntary rollover, the exposure when compared to the rest of the assets that these banks hold is quite minimal. It's about 1%. So I'm guessing that the impact of the contagion is not really that high if it's a softer option of a voluntary rollover. But in fact, the worst case scenario is of a default. What happens then? Do you expect to see the European financial markets seize up if there is in fact a default? And I'll come to my next question, which is what is the impact then on the ECB?
Well, if there's a default, then there has to be some sort of negotiated exit, and that's likely to involve haircuts. If we look at what the market is pricing in at the moment, it suggests that the haircuts on Greek debt in the event of a default would be at least 50%, possibly as high as 60 or 70%. Now, the impact on the European banks, obviously there would be an impact, but I suppose the point that I'm trying to make is that the overall exposure to Greece as a share of total assets for European banks is not excessively high. So we don't expect to see a systemic crisis developing as a result. The problem is, first of all, there would be an impact on confidence, there would be contagion, we would see Spain most likely run into problems having to tap the EU for bailout finance as well. Attention might turn to Italy, which also has a high level of debt. The second concern is that the European Central Bank would need recapitalising. European Central Bank holdings of Greek bonds is of the order of 45 to 50 billion euros. So even accounting for the fact that most of that was taken on board at a discount anyway, if we're talking about a 50, 60 or 70% haircut, then the ECB would find its capital wiped out and would need recapitalising. And finally, the Greek banks themselves, if they were to have to endure such a substantial haircut, would be left needing recapitalisation of the order of about 20 billion euros. And then there is a question as to whether that debt would be regarded as, it would no longer be valid as collateral at the ECB. There would be severe pressures for the Greek banking system in the event of a default. And I think that this is one reason probably why Greece will do its utmost to avoid defaulting.
All right, so Sarah, the last question is the simplest one. What scenario do you think we're going to be faced with over the course of the next few weeks? Hopefully the economics of the situation will overtake all the political rhetoric.
Well, you're quite right to point out that we need to watch very closely tomorrow's confidence vote. We also need to watch very closely, assuming that the government survives the confidence vote, we need to watch what happens at the vote on the austerity measures, which takes place next week on the 29th of June. Our view at the moment is that the government will survive both votes, that they will agree austerity, and that this will allow the EU and IMF to extend more finance. This will keep Greece's repayments and its ongoing financial commitments covered for the next few months. To a certain extent, it'll buy time for Greece. So obviously that's the sort of outcome that everybody is hoping will be achieved. But it is a bit of a close call given the uncertain politics that we see in Greece at the moment.
Sarah Hewin, thank you so much for joining us on Your World at 10 with your perspective on what could likely happen in Greece.